Okay, in this lecture, we're going to talk about treasury stock. Treasury stock are those shares where a firm has previously issued the shares and now has repurchased them. In other words, they kind of put them into the firm's treasury. And so we're going to talk about how we account for that, along with some just background and things like that as well. First of all, as an overview, the board of directors must approve share repurchases, which of course would be then included in the treasury stock account. And the reason that they do that is because it requires the use of firm resources, typically cash, in order to make the repurchase. And also it does change the capital structure of the firm. And so obviously for the shareholders, this could change their risk, it could change the resources available, it could change their expected rate of return. And so all these things could potentially positively or negatively impact current shareholders. And so that's why the board of directors typically has to approve share repurchases. And so what it does is hopefully it aligns the share repurchase program with the interests of the shareholders. So a share repurchase is not necessarily a bad or a good thing. It's just a matter of whether it's the best thing for all shareholders. All right, so for reasons that a firm might repurchase shares. Number one, it is, if you think about it, a distribution of cash to certain targeted shareholders. And so in this case, let's say that certain shareholders wanted a cash distribution based on their ownership, but not all shareholders wanted to. Well, a share repurchase would allow a company to repurchase shares just from specific shareholders rather than distributing something like a cash dividend to all shareholders. And so there's one more efficient way to distribute cash. Secondly, it does mechanically increase earnings per share and return on equity. But I want to be very clear, it's not always, because anytime you use resources to repurchase shares, of course, the number of shares outstanding are going to decrease, but you also don't have those resources to generate earnings. And so there is a trade-off between the alternative use of the cash. And so I would say typically firms can execute a share repurchase and increase their earnings per share or return on equity, but it really does depend on what the alternative use of that cash might have been. It also does provide stock-based compensation to employees if employees exercise stock options, or if you're going to do, let's say, issue restricted stock. Those shares have to come from somewhere, and so rather than issuing new shares, many times a company may repurchase existing shares to satisfy those compensation needs. And then another reason is it can thwart external takeovers. Typically, in a takeover situation, outsiders will try to buy up shares in order to influence what the firm is doing, maybe fire senior management, things like that, and so or replace the board of directors. And so, if a firm has the approval to make share repurchases, that will drive up the share price, and so that competition will make it more difficult for a hostile takeover. And then finally, in certain situations, this one isn't common, but in some situations, a company, there just may not be a real great market for the company's stock, and so certain shareholders may want to, sort of get rid of their ownership, but if there's not a great market for it, a share repurchase can create that market for certain shareholders who want to sell their shares. All right, so is treasury stock an asset, or is it an equity account? Of course, we're talking about it within the context of shareholders' equity, and so we know the conclusion, but there are some, and there are many who think treasury stock should be treated as an asset. And so obviously the important thing is to go to the elements of an asset to figure out if treasury stock satisfies that definition. First of all, an asset has a probable future economic benefit. It must be presently owned or controlled, and it must result from a past transaction or event. And I think treasury stock clearly meets the first and the third one. The future economic benefit is, of course, the firm could at some point reissue those shares and then receive cash in exchange. And of course, there was a past transaction or event, which is the initial repurchase. The issue really lies with presently owned or controlled. And the issue is, can a firm own or control its own stock, or kind of maybe put it more broadly, can it own or control itself? Under U.S. GAAP, FASB concluded that a firm cannot own or control itself, and therefore treasury stock is not an asset. This is a very important conclusion because what it really kind of paves the way for is if treasury stock were to be an asset, that means the firm could generate earnings off of the sale and reissuance of treasury shares, and that really kind of is a kind of a muddied situation because really what you're doing is you're benefiting certain shareholders at the expense of other shareholders. And so that really doesn't make a lot of sense as far as sort of true earnings from the company. And so that's why FASB has gone down this path. But of course, it could change its mind in the future. All right, so let's walk through an example. A firm issues 50,000 shares of common stock for $20 per share with a par value of $1 per share. The issuance takes place on June 15, 2018, and then we have two repurchases, one of 5,000 shares at $22 and the other at 4,000 shares at $23. The first thing we do is record the issuance. Of course, we receive cash. The common stock has a par value, so $50,000 is assigned to common stock and the rest is assigned to APIC. But what we really need to focus on here is the repurchases. And so the first repurchase on October 15, 2018, of course, 5,000 shares times $22 per share is $110,000. That amount goes into a treasury stock account. Now, of course, that's a credit to cash and a debit to treasury stock because treasury stock ultimately is a contra equity account. And the second repurchase similarly has a credit to cash and a debit to our treasury stock account of $92,000. Again, that's 4,000 shares times $23 per share. What the important thing here is to think about what situation are we in ultimately once these repurchases happen. And really what you have to think about is layers, sort of like when you deal with inventory. And so when we have treasury stock, we hold those shares in certain layers. And so we have one layer of 5,000 shares at $22 per share, and those are the oldest shares. And then we have another layer of 4,000 shares at $23 per share, and those are the newer shares. And so if there is a subsequent reissuance, you do have to use a sort of LIFO, FIFO, or weighted average approach to the reissuance. In other words, what cost are we going to associate with the treasury shares when they are reissued, because we have multiple costs within our layers of treasury shares. And so in this first scenario, we have a situation where there's a reissuance of 4,500 and then another 2,000 shares. And they're going to use a FIFO type system to account for its treasury stock. In other words, they're going to assume that the oldest shares are reissued first in, first out. Of course, they could have used LIFO or average cost, but again, they're going to use FIFO in this particular example. Okay, so at the initial issuance here, we see that cash is going to be 4,500 shares at $24 per share. And the treasury stock, again, because we're using the first in, first out approach, we have to use the oldest shares, which there are 5,000 shares at $22 per share. And so when we reissue shares, all of them, by assumption, are at $22 per share. And so our entry, we have a debit to cash. Of course, we're receiving cash. And then we have a credit to treasury stock based on the cost of $22 per share. And so what we do with the difference is we put it into this additional paid-in capital treasury stock account. And if you think about it, what's happened here is that we've had transactions with owners, and essentially at the end of the day, they have made a $2 per share contribution for those 4,500 shares. And so that is additional contributions that the shareholders have now made. And so that $2 per share times $4,500 per share gives us that $9,000 of additional paid-in capital. And so rather than being a gain or a loss if treasury stock were an asset, instead we have contributions in cases where the company receives excess cash. And of course then the implication is that we're going to have a distribution if the company were to basically pay out excess cash. And so in the second situation, notice that the reissuance price is much lower, and so there are going to be some interesting implications from that. First of all, of course, cash is 2,000 shares at $15 per share. In this case, we're going to be dealing with two different layers of Treasury shares. There's still 500 shares that are at 22, and then the remaining 1,500 shares are going to kind of go into that new layer at $23 per share. And so now the two easy parts of this entry is, of course, the debit to the cash that we receive and the credit to Treasury stock based on those layers. And notice in this case that the credit is much more than the debit. In other words, the cost of the Treasury stock is more than what we received. And so essentially there's been this distribution to our shareholders. And so how do we deal with that? Well, there's sort of two accounts that we can target. The first account that we target is there any balance in our additional paid-in capital Treasury stock account? And so we know there's a prior balance of $9,000, and so that's the first account that we target. If there's not sufficient additional paid-in capital, then much like a cash distribution to owners, at that point we would debit retained earnings for any amount above our APIC account balance. And so in this case then our retained earnings would be debited for the difference of $6,500. If you notice, this is very similar to a cash dividend. Essentially we are making a distribution to our shareholders, and that distribution essentially is coming out of earnings because there's really no other source for distributions to our shareholders. So let's use an alternative example. Let's say instead of the reissuance, let's say they just decide to retire the shares. Again, this is a little bit different because there's really no receipt of cash. Instead, they really have to undo the original issuance. And so that means there's going to be a debit to common stock and potentially APIC common stock. And I know in this case, both accounts were used at the initial issuance. And of course, we do still have to credit the Treasury stock. In this case, it's all of the shares. And so we have both layers, one at 5,000 shares and the other 4,000 shares going out the door. And so the entry, again, we're undoing the common stock issuance. The initial issue price was $20 per share. $1 of that was in the common stock account, and $19 of that was in the APIC common stock account. And so that's where we get those two debits. And Treasury stock, of course, is credited for the summation of the cost of our shares. And as we had already said, since there is no additional paid-in capital Treasury stock, essentially this ends up being a cash distribution to owners at $22,000.